You want to get us started a little bit while we go?
2 o'clock. Yeah, you know what?
Am I
Let's
getting
do
us
that. Let
started?
me no, let me get you some ground rules. If you joined us on the
Okay.
call a couple of weeks ago, same ground rules apply. So we have a Q&A that's helpful for questions, easy questions only. The hard questions we save for later. There's a chat as well, but Q&A is a little easier if you kind of want to ask questions or chime in. Chat may be helpful. We'll have people from our team jump in where possible and answer the questions, or we'll just hop in and answer them live on the call. So use the chat function, use the Q&A, and obviously we're sharing a copy of this presentation or the recording of it, so you'll get that emailed and provided to you after the call.
Love it. And then,
Yeah, buddy.
yeah, we can. One thing to note as well is that kind of weird. This is not. This is kind of a real estate tax 301 class. So we're going to try to provide as much background and as much kind of color commentary. There's not CPE for this, but I mean, we don't offer continuing education credits, but this is kind of presented like a accounting CPE call out there. So, if we're jumping way past some foundational information, we'll try to get back to it. We'll try to kind of go from first principles all the way up to complex topics, but we're moving fast over here. So we're excited that everyone took the time to join us today. So I'm Mitchell Baldridge. I'm a CPA. I'm a financial planner. Um, I'm in Houston, Texas. We run a few businesses over here, but Roger and I together are partners in Baldridge Financial, a CPA tax accounting firm. Roger, you introduce yourself.
Yeah, well done so far. Heavy kind
We're
of,
crushing.
listen, CPA, been in practice for 17, 18 years. Started my career in kind of the audit side, financial statement side. Switched whatever 10 years ago, kind of just went heavy tax, pass through partnerships, real estate, and we built a really good real estate practice. I think we've kind of honed in on um, that industry, then that kind of niche. So syndicators, we work very closely with Ari Koseg on same thing, those types of deals, those types of assets.
So, all right. Mark Klein says we have a bad echo. Do we have a bad echo? Oh no. So the disclaimer is basically this is my lawyer made me write this. We have a powered tool in use. We are giving tax advice here, but it's not really tax advice. This is general information. Do not get on a webinar and follow tax advice. Do not make investments based on webinars, people. It's just generally a bad idea. We're going to do our best to provide a bunch of helpful information, and if you have specific questions, reach out. We can help you.
Yeah,
Roger,
well done.
kick us
I'll jump
off.
in. Again, if the echo picks up and it's tough to hear, let me know. So we've kind of designed this presentation, this discussion, really in two parts. So we are obviously going to talk about the one big beautiful bill impacts on real estate and really impacts on partnership and other things. But that's the second half. And what we wanted to do at first was talk about what's the framework for real estate tax planning. Like what are kind of the three things that we look at when trying to set up a client? We get a new prospect or a new client, or someone comes to us and wants to know, all right, what are my core principles that I have to abide by and follow to really get the most bang for your buck with the time and energy spent developing real estate. And so we've separated into these three buckets, right? It's operating agreements and K1s, making sure those are talking. It's timing. It's using timing as the tool for planning for income, planning for deductions, and then it's just structuring. So it's what entities do you need where? What do they do? How do you get the most from your tax structuring? And so what we're going to do, we're going to talk about these concepts and these principles, and then when we get into, thanks for confirming, Tim, when we get into the one big beautiful bill, we'll be able to reflect back and say, okay, how are these relevant? What are the changes in the one big beautiful bill? How are they going to impact our framework that we're talking about? So enough about the background of it. Let's dive in. And admittedly, I'm a nerd when it comes to this stuff. I love reading operating agreements. If you follow me on Twitter or newsletter, you'll know that I talk about this stuff a lot. And that's because operating agreements and K1s, for the people who are raising money and raising investor and LP equity, this is critical. So out of, if I look at 100 new tax returns a year for prospects, 80 of them, 80% of these K1s are wrong. They don't follow what it should have been done or could have been done in the operating agreement. And so this is kind of our step one. When we're looking at new clients and structuring for most optimal tax benefits, it's making sure that your operating agreement language feeds the tax returns properly, and then it's followed, right? And so I'll dumb it down even more or go back even further. Operating agreement is something that every business has or should have written down, right? And so it's a lot of legalese. It's formation of the business, who's the manager, who's running it, buy sells. Like there's a lot of the legal things you can put in there, but there's really important tax language for how distributions are shared, profits, hopefully, and like allocations of income and loss, right? So those things are in your operating agreement as well, amidst all this other legalese. And so what we do is we dig into that and we make sure that the operating agreement language agrees with what the investor expects, what the GP expects, right? And so I talk about these. There's more, but there's really two most common types of
So
language that you see. Yeah,
just to kind of set the table, like real estate, we deal in a lot of syndications and a lot of people buying real estate, raising capital, raising debt, operating the real estate. When you go out to the market to raise capital to go buy a piece of real estate, you disseminate an offering memorandum, or you go say, hey, we're going to buy this property, we're going to raise this amount of capital, we're going to go raise this debt, this is our thesis, this is how we're going to operate it. So that becomes the initial kind of go to market idea, and that
yeah,
should theoretically then feed into the operating agreement, that somebody, there's a deal memo, there's an operating agreement, there's a capital raise, kind of there's a bunch of legal documents that you'll sign to hand somebody $100,000, and those should be informed by what you said was going to happen. And a lot of times these documents don't even really address tax. Or if you're going to be a limited partner or a general partner raising money, or writing a check into a deal, you ought to know how the tax, uh, how losses will be allocated, capital will be allocated, income will be allocated, etc. There's just many times a disconnect from there to there, and then after the money's raised, the building's bought, it's been run for a year, we're sending out K1s. Sometimes that document has no kind of bearing on what originally happened. Is that fair to say, Roger? I don't know if that
bingo.
simplifies it or makes it
Yeah,
more
no, I think that makes
complicated.
sense, right? So I talk about like there's this step process to get to produce a K1, right? The K1 is what you get as an investor in a partnership or an S corp, God forbid, but in a partnership, you get a K1 as like your reporting of income or loss from that activity. Well, that K1 is driven by the financials of the property and the operating agreement. And the operating agreement is informed by this kind of deal memorandum, this what Mitchell talked about, like this first pitch deck you sent out to investors, right? And so it's our job as tax preparers and advisors to make sure that the K1s are in line with investor expectations. So there's a breakdown that, if between the OA and the K1, there can be a breakdown. But on the legal side, between the offering memorandum or the private placement memorandum or whatever, and the operating agreement, there can be a breakdown. And so I don't know, I'm out here, I just try to spread the gospel that like, hey, let's talk about these things, let's spread this information. Um,
So this
And
is a
so, yeah,
foundational, like when we get a client at the very beginning, hopefully this isn't a problem because we're leading them the whole way. But oftentimes, when we get a new client in the door and I flip the returns, the first thing Roger's going to ask for is give me the tax return, give me the operating agreement. Let me make sure that this is all jiving together. And so, one of the first kind of hurdles we often overcome is like, hey, just so you know, it says you're going to do this and you're really doing this. And what do you want to have happen here to get back into
yeah,
alignment with what you're doing versus what you said you're going to do, and here are the consequences to even get back into order, right?
yeah. And so, yeah, I throw on these terms in here, but like maybe we can talk about an example, right? It's like a common example of what I'll see is, we'll get an operating agreement, and it will have what's called target capital language. And so, this is an easy way. You can just go to your operating agreement and do a Control F and look for like
It's easy.
hypothetical liquidation.
Yeah.
You can look that up. So like hypothetical liquidation usually is going to be target capital. And what this means is this usually implies that there are tiers of priority capital, tiers of priority investment by investors, right? So you'll have a class A who could just be, I'm just getting an 8% pref and I'm getting my money back. Class B would then be, okay, I'm paying class A their pref, but then I'm getting losses after that. And I'm getting all the benefits on the upside after the 8% pref is gone. Class C is then I'm just getting a promote, right? I'm just getting a share of the profit if and when there's profit. And so if we just use those three classes, A, B, and C, as like the kind of the baseline, what happens in target capital is if you have a big loss, so you take a big cost segregation study done on your big building, and you have a lot of losses that first year in service, well, in a target capital allocation, class B, because C doesn't have any cash in the deal, they're just interest, profits, interest only. But class B would get all the losses first, and then class A would get the losses, right? So it's not class A and class B are not going pro rata on these big losses. It's the complete opposite if you have what's called safe harbor allocation language, right? Class A and B would get pro rata sharing of losses. And so it can be a really big difference when if you're a big investor in class A and you're expecting to get a humongous portion of depreciation, and then you get a K1 and it
And
shows just income from your pref. Like that happens a lot.
yep. So,
So yeah,
long story short is like these operating agreements, Roger's really, really good at reading them. Attorneys are good at writing them, but oftentimes when they get written, when they get disseminated through the investors, many times what gets signed isn't exactly what they thought was going to happen. And then at tax prep time, it can go off the rails or it can all just be done wrong. And so this is something we foundationally focus on that just doesn't get talked about a
yeah,
ton. So
exactly right.
we
Yeah.
might have talked about it enough.
So then like the last thing on this slide, I told you I'm gonna nerd out on this because I love it. It's like I threw an example of like what a potentially a incorrect K1 looks like, right? And so like this little blurb you see at the bottom right, like with the box L. So this is what you could get on a K1, and you'll see at the bottom of it, it shows a very large negative, what we call a negative capital account. And so this can happen. This may not be an incorrect K1 under the right circumstances. But what often happens is someone will say, oh, a preparer can say, oh, no, my client is the GP and they were promised all the depreciation. So we gave it all of to them, right? And they can wind up with this really big negative capital account. But what's happening here is these losses, this $1.5 million of losses, is financed somehow. Like someone paid for these losses is how I think about it. So they either came from other investors or they came from debt. And if they came from other investors, it can still happen this way if you have some more terms in your operating agreement we won't go into. But generally, what happens is they finance all of these with debt, and you have these big losses. And so those generally, again, in our example, they would go to A or B under safe harbor, or B first and then A under target capital. And I just threw it on here like there's ways to get this done. There's ways to do this, but it's got to be reflected in the operating agreement language. And so we'll talk about it. But as we approach again this another wave of and a new regime of bonus depreciation, 100% massive ability to finance losses with debt, this can we have to make sure the operating agreement has to respect the K1 allocations we're going to do or we can do in line with the tax code. All right,
Yeah.
soapbox
So
is over.
we have a question. What's the value proposition to investors that are not real estate pros who have partnered with a real estate professional regarding cost segregation? Or even if none are real estate professionals and the investors don't seem to find much value in cost segregation. So, I mean, this is sort of what they're talking about or what they're asking out there is just, you know, uh, ultimately, to Roger's point, with the new regime of bonus depreciation and with the stuff that I'm talking about on Twitter and everyone's talking about online of like, oh, buy real estate, drive all these losses. Well, there's no there's no free lunch in the tax code, except maybe the step up on death or the opportunity zones that we'll talk about. Like there's ways out at the end of the rainbow, but today those losses are all coming from somewhere. And figuring out how you want to utilize the losses and what is going to be the best use of all these losses and for who is it adds complexity to your deals, but then it also all this is designed to do is lower your cost of capital. Really, like all of these losses in real estate create this capital offset up front where you can buy more real estate with less cash. And so, making sure that your losses are going to the right people is important. We'll talk a little bit more about
Yeah,
that.
I think it's fair to say that these losses will, for a non-real estate professional, these losses will offset other passive income.
Mhm.
And if you don't have any passive income and all you have is real estate losses that are passive, you won't lose them. They'll just sit there, right? And so they'll kind of sit there. And we are going to talk about in a slide about timing, right? So
Yep.
when the cost segregation, I think it's the next slide, when cost segregation matters a lot to play this
Let's,
game.
let's get to it.
Let's go. So this is another big lever, right? And it's not always year one slam dunk, do the cost seg, right? Very different things can happen based on the allocation language we saw in the operating agreement for who gets those losses and who's going to benefit from that, right? And so, quick example: when OZ first came out, when you have investors in an OZ, they don't really. It's all deferred gain. They haven't paid tax on that capital, so they have no tax basis in it. And so you have the opportunity, and a lot of the times the debt is guaranteed by the developer, the general partner in it. And so you have this opportunity to cost segregate really quickly before they have step up or they have a tax basis. This made massive swings in depreciation allocations. So that's kind of one example of a cost segregation study and when you can use it. So here's a couple of other ones: this guarantee of debt, right? Um, and early on, usually what happens in the life cycle of a property acquired, early on, the general partner or the syndicator, the person putting the deal together, is going to have a guarantee on the debt. And in this regime of 100% bonus depreciation, if it's moderately or highly leveraged, a lot of the times you'll get big depreciation that will outweigh how much in actual cash capital, like investor capital, went into it. And when that happens, the question has to be, who's guaranteeing the debt, right? Again, back to this concept of who is financing these losses. If the losses are being financed by debt, right, they've gone beyond the amount of capital contributed by investors. If the losses are being financed by debt, then those go to who's guaranteeing the debt. If there's a guarantee on the debt, those excess losses go to the GP, right? Until such time as there's no more guarantee. If there's not guaranteed, those losses kind of get shared more pro rata. And so we talk about this kind of like, okay, well, who's guaranteeing the debt? When is the guarantee going to run off? When are you going to do a cost seg? So some GPs can say, I'm going to wait to do the cost seg until after I stabilize and refinance and remove the guarantee. So then they'll get more of the depreciation. Others will say, my LPs don't care. It's passive to them, or they're institutional. They can't use the depreciation. So I'm going to use the cost segregation study year one when I have the guarantee on the debt, and I will get a lot of that excess depreciation or extra depreciation. So again, that's one example of how timing, when you want to use these cost segregation, these other tax benefits, matters.
Yep. Yeah.
So
So yeah, there's a bunch of ways that, and it goes asset by asset, deal by deal. And again, this is like real estate tax 301 or whatever. But this is these are the common themes we start to see over and over and over again with our clients who are doing a bunch of real estate syndications. Now, when you're just on your own and you're going to go like take out a 20% loan and go buy an Airbnb, you don't have to worry about any of this. So that this is not,
I
but
mean, the other thing is to consider for those guys, like, when are you going to have an income event, right? So
yep.
if you're buying an Airbnb and you're going to Airbnb it, do you have any RSUs? You're going to like, we try and find these big non-cash income events, and you can time it. Like, you can bonus depreciate, or you buy the asset and you don't cost seg it year one because you know in year three you're going to have this big phantom income or real income event. You're going to exercise stock options or whatever. There's ways to offset even those guys who are the STR warriors.
And so NM says, do we file the operating agreement along with the taxes? Haven't done that so far. Not sure how the IRS would know, what my operating agreement looks like. And like the IRS won't know unless you're audited. You don't file your operating agreement with your taxes. Your partners will know. And the only time this stuff comes up, or like the times that this stuff comes up, are you're being audited and you weren't following the operating agreement, and all of your allowances and allocations get totally recast, and it screws everybody up, or you're being sued, or your deal's going
Yeah,
bad, or or your bank's
more
looking at this
likely.
because you're refinancing, and that's when this stuff comes and gets you.
Yeah, you don't want two people to know your operating agreement better than you, and that's the IRS or tax court, and that's your biggest LP's attorney. You don't want them to know your OA better than you do. So again, try not to go back, but it's a big thing. It matters a lot.
Yeah.
So yeah, so I think, listen, there's STR plays here. We talk about promote crystallization. That's 402, 502 language, but like, we
Yeah.
look for these times when your basis is established, or like how your debt basis changes in a partnership, for when it's really you. There's some strategy and decisions to make by GPs, and we have these conversations. And so that's timing of deductions, right? I'm going to talk about timing of income and acquisition fees. This is really more for if you're buying a property. So if you're raising equity and you're buying a property, a lot of the times you get 2%, 3% of the value of the property for doing your job. That's intended to offset cost that you had, time that you had paid, putting the deal together, whatever, right? But that can create this phantom income event if also you're co-investing, right? So let's say you have a $300,000 acquisition fee coming your way, but you're also going to pay in $300,000 to the deal as a co-investment. So you're going to co-invest with it. You got skin in the game. A lot of the times when you can structure this language in the operating agreement that allows GPs to waive these acquisition fees. And by waiving it, you just get additional carried interest, or you get additional promote, right? And so you still have to pass these hurdles and meet the smell test for a carried interest to be applied and not be taxed. But it can change this tax burn of cash you didn't get. You got 300, you put 300 back in. Instead of paying tax on this 300 and losing
Yeah.
90 grand of it, and then putting 300 back in it and having a burn of 90, we can defer all of this and treat this as just a additional profits interest on the back end. So again, it just goes to the fact of like, how do you want to time this? Well, how are your asset? How are you kind of capitalizing this? What is your participation in it? These are all just discussions we have when we're kind of buying properties with what our clients are.
Yeah, the general partner or deal sponsor has the added pressure of sometimes I can't even get the depreciation up front because I don't have enough equity in the deal, and my partners want all the depreciation. And further, yeah, I'm earning this income for putting these deals together, but I'm expected. Brokers deal with this a lot, and they don't they have a way through it as well. But like brokers, they go, I'm earning a $50,000 fee to put this deal together, and then the guy who is doing the deal wants me to go around and put my fee back into their deal, and now I have income on this side and no deduction on this side. Well, cost segs can help that as well, but yeah, it happens with GPs as well, where if you can defer your acquisition into the deal and not have to recognize the income, you don't get the basis on one side, but at least you're not having to put all of your cash in net of tax and getting burned.
Exactly. Yeah, that works. So let me go to kind of our last. Oh no, Mitchell, we lost your video. There you go. Um, Let me go to our last slide, or kind of our last framework slide, and then we're going to get into how the new tax bill is impacting these on the real estate. And so another original Roger Ledbetter drawing here. But this is when I have a whiteboard when I'm meeting with a client. This is what I draw, right? I put this up on the screen, or I have this on my OneNote, and I start sharing it because it just helps me conceptualize what types of entities should be where, right? And so we always start with, we want properties and or prop code, we want that in a partnership, right? Primarily, a couple of reasons. Primarily, it's more flexible allocations, right? So this lets you have a profits interest, this lets you have or a carried interest, or like an additional allocation of gain that happens from it. So if you do a good job of buying the property, fixing it up, stabilizing it, renting it out, or taking care of it, and then you sell at a big gain, as a sponsor, you get a bigger upside. This is one of the ways, one of the tax advantage ways you get compensated. Well, we want that special allocation to withstand tax scrutiny, and so we want that to be in a partnership. Partnerships have very flexible allocation rules. We also want that debt basis, right? That basis we talked about. Where does the debt go once you've exceeded, or where does the deductions go once you've exceeded all the capital contributed? That's debt basis. Who gets that debt basis to take those losses financed with debt? We want that. The S corps don't have that, right? And so we always talk about propcos, property levels are in partnerships with debt, and then those will pay fees. We talked about the acquisition fee, but there's other fees, management fee, asset fee. So there's other fees that happen. Those generally get paid to what I'm calling an opco or a management co. This is your operating business. So if you have a management company, in addition to the properties you have raised and syndicated or purchased with LP equity, you probably, if it's large enough, you probably want that to be an S corp, right? If it's a partnership for you have other partners in it or whatever reason, fine. There's some way to work in an S corp there. There's some way to layer in an S corp. S corps have a couple of different things, but the biggest benefit of an S corp is this concept of QBI. We are going to talk about QBI as a part of the one big beautiful bill changes, but QBI gets you an additional 20% deduction on those fees coming to you, right? So on these fees going from partnership, propco to opco, you're getting a deduction there, right? Then you get salary, you have to pay yourself a normal salary, or fair salary out of the S corp, but you also get profit distributions, right? And the distributions are what gets you this additional qualified business income deduction, right? Without this, if this was a partnership or just you, like if these fees just went to you because it's still small, you're going to have some tax burn, right? You may not get all the QBI if your income is too high. You may not get additional deductions. So there's other things that you're going to lose out if you're not an S corp. And then I throw in the co-invest, right? I like the co-invest to come from the the GP personally, right? Or just not from an S corp. Because what we talked about, you're going to have debt basis here. I need that debt basis to flow through to you. That debt basis, once it flows through an S corp, I lose that debt basis, right? And so we structure, how are you going to co-invest in this to get that debt basis, which again helps you generate losses. Especially as a real estate professional, you use those losses to offset all of your income that you're making from all your other real estate activities.
The other big issue with S corps is you can't freely contribute and distribute property. So beyond, yeah, you can't use debt in an S corp to finance a loss, and you can't contribute property and then go distribute property. So it leaves people in a lurch sometimes. And if you bust your S corp election somehow, it becomes a C corp, and then you get really stuck with double tax and a bunch of things that you don't want for a
Yep,
highly depreciated piece of real estate out there. So,
bingo. Well, I saw a question in there. Propco must truly be a partnership, or is LLC fine? So yes, but so an LLC is fine. Because an LLC, again, for federal tax purposes, can be a partnership, can be an S corp, can be a C, can be everything. Um, so it's okay to have Propco set up as an LLC taxed, what we would refer to as taxed as a partnership, with the exception that if you're in Texas or your property's in Texas and it's a limited partnership in Texas, LP, you can technically, if you sell that property in the first part of the year, you may be able to qualify that LP as a what's called a passive entity. So if your gains are, I'm going to forget, if your gains are more than the gain from the real estate, the capital gains are more than 20 or yeah, more than
big
25% of what's the rule. So if capital gains are the significant amount of the income of that activity for that year, you don't owe franchise tax. It's considered a passive activity. This is Texas, right? And so it's a timing bet, but if you're going to sell that property and make $10 million on a gain, Texas franchise,
this
that could save you a chunk.
and this goes to say that just like ultimately, we're somebody said, when are y'all going to talk about the big beautiful bill? So we'll get there. But no, ultimately, like the whole reason we're having this conversation is we're just talking to the people who are our clients out there, who are these real estate general partners who you go, you spend all this time and all this money, and you hunt down a great deal and you raise all this capital, and to just gloss over the whole, how am I going to structure this thing, what is the OA going to look like, how is this going to work, is not something that you have the you don't just get to do that. Like, you don't just get to say, hey, I don't understand taxes, and my lawyer's going to take care of that. Like, they will, but unintended consequences might happen if you don't think through, when I buy this and when we raise $1 million and when we borrow $2 million, and the loss comes next year, what's going to happen? When we go sell it in 5 years, what's going to happen? And so someone asked, Roger, like, how big of a deal do you need to do to, or who does this structure apply to? I mean, if you just do one deal, do you do this structure, or do you have to have a bunch of deals, or how does
Yeah, I
this
mean,
make
there's some brain
sense?
damage to setting it up. It's got to make sense. It's got to be sustainable. If you're just unlikely, I mean, maybe there are a couple of people who during the ZERP era just ran one or two deals because it was so juicy. But generally, listen, if you're gonna buy properties going forward, you're gonna raise equity going forward. This structure makes sense for you, right? If
Yep.
you're gonna buy your own apartment complex and kind of dip your toes into it, don't do the S corp, a partnership, or you own it personally. Not an attorney, but probably through an LLC or some sort of legal protection. Not legal advice, right? Go back to the second slide, but this is probably overkill if it's just going to do one and done, and you're not raising equity.
So, but ultimately, this is just essentially we have one business that's the management kind of uh, asset manager, property. You may have a different property. Like, if you have 30 properties, you're going to have a property management entity, an asset management entity. You're going to have some payroll entities, some like you're going to have entities everywhere. But really, you need this one operating management co, and then you have an LLC for every one of the properties that you go buy. Like that's the most common way that this works. Um, Mike Mike asks, "Will you please define debt basis?" Really, this is this idea, Mike, of like, I'm going to go buy a property. I'm going to raise $1 million of cash. I'm going to go borrow $2 million, and year one, I'm going to have 1.2 million of bonus depreciation. Well, We've now burned through the whole $1 million I've raised. That's all a loss. And now we're getting into $200,000 of the debt tranche. And debt basis just means that whoever's guaranteed, or if the loan is a qualified non-recourse loan, meaning it's attached to real property, that even though you've burned through the whole $1 million you put into the deal and there's $200,000 of excess losses, the IRS basically says, hey, you can still deduct that $200,000 because because you have you either have your name signed to the loan and it's recourse debt, or it's attached to a real property. So that's
Yeah,
debt basis is the IRS will let you take losses against money you borrow.
I think Anon is like steaming that we haven't gotten to one big beautiful bill yet. Now we're
Let's
talking about
go.
debt basis.
Oh,
So
here
here we
we
go.
are, baby. All
There you
right.
go, Anon.
Come on. We got this. So one big beautiful bill. So all of this changed July 4th. We again, you can email us after this, and we'll get you the last slide or the last presentation we did. Really about we did an hour on the big beautiful bill. Right now, we're going to do 24 minutes on it, and we're really talking about the real estate focus element of the big beautiful bill today. So, but we're gonna get into it right after this ad from our sponsors. So, this is sponsored by Baldridge Financial, our CPA firm. We do tax and accounting for you know small business owners, real estate pros, real estate syndicators. This is what we do. All of this nerdy stuff we're talking about, you don't have to worry about it, and we can take care of it for you. We work in this system of strategy setting, working with folks to set up game plans, working on catch check-ins, integrating the accounting with the tax, and trying to get all the tax returns done on time for you and your partners. We file a zillion K1s every February and March. Who we're looking for today is if you have a bunch of properties and you send all your K1s out in August and you want to get them out in June instead, call us. But we have some space for some more big groups doing February K1s, but everyone wants February K1s. And then
We like this.
this
The
is
summer K ones are great. Yeah.
the summer K1 people. We love you. This is also brought to you by Ari Koseg. Ari Koseg is a firm I'm a partner in. We do cost segregation studies for real estate investors. Go to arikoseg.com. Use the discount code BIG10 to get 10% off your first purchase. Bonus is back. We're about to talk about it, and so let's get to work. So yeah, back to OBBB. The real stuff that happened is bonus depreciation. It's 100% back. QBI is permanent, which we'll talk more about. Qualified business income opportunity zones are permanent, and they're back. This big manufacturing deal is back. Roger would talk about 463 and 163J. This gets deep and nerdy, but this was a big problem that we were dealing with folks who had debt and we're trying to do cost segs out there. And then they're killing all the green energy stuff. So bonus depreciation, it's permanent, it's the law of the land, it's 100%. Somebody asked, so this is for assets that are acquired and placed in service after January 19th. So if you had a property that you bought in 2019 where that was 100% bonus territory, but you never placed it in service until 2025, you're going to be stuck with 40%. If you bought the property on January 17th and placed it into service, January 23rd, you're still stuck with 40%. So it's for assets acquired and placed in service after January 19th. They didn't go back. They didn't fix the drawdown. They just kept going with it. So, presumably, next year assets if you place a 2019 asset into service in 2026, you'll have 20. If you place a 2019 asset into service in 2027, you won't get bonus. So this qualified production property is a big deal. Basically manufacturing in America where you take, raw material and churn out widgets, property where that is done qualifies for 100% bonus eligibility. So it becomes like a gas station, like the entire building gets to be written off with, in the first year, which is pretty wild. Um, if construction begins after, January 19th and is completed by 2031. So this is, they were really clear about this the whole way through. They want a MAGA. They want to, produce things in America. This is how they're going to do it. They want to go build property in America. And so to the extent you can build a manufacturing facility in America, that's a boondoggle today.
It is a boondoggle. Yeah, so I mean, we talk about impacts of on our real estate framework, and Anon, this is why we did this. We wanted to set our framework up so that we can now look back and reference it, right? I've talked about. So what's happening here is we have again these giant depreciation losses. Where do they go? What LPs or what GPs get them, right? And so this is where we look back and we say, oh, the operating agreement is what's driving LP expectations. And so when you're out there raising equity or when you're raising money, this should be a discussion because your LP will or could, a savvy one will ask, what does the allocation look like on year one? How much losses am I going to get? And you don't want to have to go back and explain, oh, the OA language or the operating agreement language was bad. And so it just increases the scrutiny that should be on this operating agreement tax language, right? And so to the other point, you're right, you don't file it with the IRS, but you want it to be tight and you don't want investors to question why the allocation is different than they expected. And the other thing is, again, these are if you're leveraging up, it's expensive leverage right now. Credit's not cheap right now. This isn't 2022, right? Debt is very expensive. And so you're paying a lot for these deductions. You need to make sure that you're using them in the right year, right? We talked about, do you wait for the
Yep.
cost segregation study? Do you get it and then use it later? Do you use a method change, a 3115? There's games to be played. And so you need to think forward 3, 4, 5 years. What is a big income event that I may encounter? And how can I use this cost segregation to my benefit? Or if not, do I just give it all to the LPs up front because they like seeing big negative numbers with distributions? Like totally up to you. But again, there's big numbers. And so we got to look at, okay, what's the most tax efficient way to use these losses?
There's a great Michael Kitz's chart out there that I've referenced a few times, which I've coined the term lifetime effective tax rate. But effectively, like I I have a site called bonuslevers.com where I just made this little calculator that we're vibe coding for the front of the Ari Koseg website. But like there are these levers to how you get to use Koseg. One of them's, land. How much land is versus property is there? You're not allowed to depreciate land. There's the 1245 short life depreciable bonusable property versus the foundation and the roof and the central HVAC and stuff. There's, the bonus rate. Is it 100% bonus? Is it 40% bonus? There's the amount of debt you have on the property. If I assume your loan, Roger, and hand you $1 for your industrial facility, my dollar is going to go generate a ton of bonus relative, no matter how much bonus it generates. So these levers are worth thinking about. If you're buying a property for bonus, it's worth thinking about how to buy a property for bonus. Um, the other thing out there, as you're talking here, let me pull up the question. Oh, basically, oh, somebody asked if I redeed or sell my property to an LLC, can I get 100% bonus? Well, Roger will
Not
be
once we put it
talking
in
about
writing.
that in today in tax court in like 7 years. You'll be talking about that. So
The answer is
I
probably
don't know.
no. Yeah, there's going to
Probably
be
not.
anti-abuse rules. Yeah, no.
Yeah. So if you can think about that that quickly, the IRS has they'll even get to that one. Don't worry. So QBI out there is extended permanently. So in 2017, they lowered the corporate tax rates from 35% to 21%. And in doing that, they said, okay, we need to throw, so that's the C Corp tax rate. They said, we need to throw a bone to the little guy. We need to help small businesses. And in order to do that, they gave small businesses a 20% deduction. So these pass through entities, S Corps, partnerships, even the Schedule C kind of small business. Now, there's a phase out. If you're a high income person, it was at 25, they increased it to 150, as you earn 150 of family income, um, or I guess 300 of family income, they start to phase out the amount of QBI you're able to take. And your salary is one element of how you can kind of step up that phase out. So we have a couple of people asking about reasonable salary. Like the question is, how much salary do you need to pay to optimize QBI, or how little can you pay to be within market? And then there's these specialty service trade businesses like accountants, like lawyers, like doctors, like actors, and who still have these limited phase outs. They were doing a bunch of monkeying with how it was all going to work, and that kind of went away, and they've mostly kept this all the same. But this is part of why we have the S corp in the structure, because that helps investors optimize QBI. Ultimately, it takes folks who were at like 37% effective tax and takes them to about 29-30% effective tax at a federal level. So it's a big deal, and it's good that it's permanent. Like, it's worth saying that like all of these Tax Cuts Jobs Acts benefits were expiring, and everyone's taxes were about to go up really, really big. That's part of how the administration got this done. Like,
Yeah,
it was not tenable to anybody, Republican, Democrat, otherwise, to just have the whole thing reset and have everyone pay more tax. Like, nobody was going to be happy with that. So this is
yeah,
how they jammed it through July 4th, you know?
yeah. You mentioned already, but impacts on framework again. QBI S corp is still a play. Like this is why we still look at the management company, the opco, and assuming it's going to continue on with that consistent level of activity, you make it an S corp, QBI, other deductions, self-employment tax, potentially some savings there. The other thing is PTET is still a big workaround, and so you need to run that through a part or a S corp potentially if you're going to owe state income taxes. Texas is not a personal income tax state, but there are states that we work in that do have this, and so the S corp is a play there or a partnership, right? And again, PTET is a little bit of if you're avoiding this limitation on personal income tax deductions you're paying. So if you pay more than $40,000 of state income taxes, you are going to get limited on how much of a deduction you can take on that on your personal tax return, on your 1040, on your federal tax return. PTET, pass through entity tax, is kind of a workaround where if the business pays the tax on your
Yep.
behalf, you do not get uh, reduced amounts of deductions, right? You still take the deductions. There's rules to follow. Each state is different. It's a freaking headache of a workflow, but S corp is still a big play in our org chart and how we kind of structure these things out.
And they were threatening getting rid of the pass through
Yeah.
tax because that mostly affects California and New York and these high income tax states. A couple of people have mentioned a couple of times about this. There's this concept of excess business loss rules. So if my
Mm.
spouse is a real estate pro and I'm a physician and I make $1 million a year, and they go figure out how to lose $1 million a year, you can only offset your business income by like 600 and I think $30,000 if you're married, or 315. So like, I had a prospect client who was a big hedge fund guy who made $10 million and tried to go write off a $10 million W-2 and tried to go write off $6 million with car washes, and figured out too late that he just couldn't do it, and it was a bad deal. So like bad things can happen. When you're going into investing your hard-earned money and trying to make a tax maneuver happen, you best not miss.
F
So
in the chat, poor guy.
F in the chat for that fella. Yeah. So Opportunity Zone 2.0, we're getting to the last 10 minutes, so we got to just blow through this. We might run over, answer questions and stuff. We'll be around for a little while, but we value your time, so thank you. Uh, OZ 2.0 extends the program permanently. This Opportunity Zone thing was, hey, we want to develop underdeveloped areas. We'll let the governors pick these areas. We will allow you to take a capital gain. Hey, I bought Tesla stock for $100 and now it's $1 million, and I'm going to defer my $1 million capital gain into this piece of land that I'm going to develop on. Well, they allowed folks to defer the income and even exclude part of the original income for like 9 years, and now that is coming due. The folks who enjoyed that deferral are going to have to go pay the taxes for that in 2027. Um, the new deferral mechanism doesn't allow you to defer income, but it does allow you. So you took this $1 million, you're going to pay tax on it, and you're going to go take now the 750 post-tax capital gain, put it into this development in the Opportunity Zone. Well, if you hold that for 10 years, you get to go sell it tax free. And so what OZ 2.0 did is it made the program permanent. It kind of like we were never that excited about it, just because it was a temporary program, and there were just a lot of kind of like questions the whole way through. It was this 3-4 year ramp up of how exactly is this even going to work. No one knew if it was going to be punted forward. Well, now they've really done a good job of just providing certainty in this whole thing and saying, basically, here are the rules of the game. Here are the rules on the board going forward. Go play the game. So we're frankly excited about them now because people who invest in these will be invested in them for 10 years. So and GPs and developers are going to be excited about them too because they just have a certain rule set now.
Yeah,
So
just the tiniest bit of color. Just again, timing really matters on these because you're gonna have a 5-year gain deferral window. And so again, you're going to have very big differences if you cost segregate in year 1 through 5, who's got the basis, capital or debt basis, versus who's doesn't have that basis. So these investors don't have tax basis because they haven't paid tax on this investment, right? Once they pay tax on it after year 5, generally what would be nice is it or an additional kind of value add as a GP raising OZ funds is if you say we're going to wait to we'll do the cost segregation study now, we'll pay Mitchell now, but we're going to sit on it and do the 3115 and put it and do the bonus in the year of inclusion, right? And so it'll offset that gain that you're going to have to pay tax on that it's down the road and you've invested this money, and it could wipe out a lot of that gain. So again, there's a lot of games we play the timing on OZs and when they have to pay tax on that investment to think about.
perfect. So
I'm going to take it. Yeah.
yeah, we're getting deep into 163J and 460E. Explain to them kind of what happened in 2017, what we were having to do, and what we're doing going forward, I think.
Yeah. So two real quick things. 163J it's an interest limitation. And so in 2017, the tax law that came out limited how much interest you could deduct for things like a rental property. And it limited that to like 30% of adjusted income. Well, one of the adjustments that you could take for the first 5 years of this was depreciation, meaning if you took a lot of depreciation, you could add that back to determine how much interest you could deduct. It was very useful, so you wouldn't have to limit, you could still get full deductions for this interest. That phased out. I think 22 was the first year that phased out, and you could no longer add it back. And a lot of people either lost deductions on interest or had to make tax elections to avoid that and go around it. That's back full time, right? So now we get a full add back. It just means that you can deduct more of your interest expense, which is nice because I mentioned that interest expense now is very different than it was in 2021. And so you're paying a lot more money in interest expense. You need to make sure these elections are in place. And 163J makes sure that you've got it tightened up. The other thing I do want to talk about is if you're listening and you build apartment complexes or condos or things more than a fourplex, you need to know about what's called 460E. It was literally the smallest section in the one big beautiful bill. It was like half a page long. But what it did is it allows you almost like a cash basis, regardless of how big you are now. It's not even looking at revenue size or gross receipts test. It's if you build residential contracts, and there's other criteria, but it's a lot of these real estate or apartment developers will meet this test, where now you don't pay tax on these income these contracts that you've performed on. You don't pay tax on that until it's completed, right? This is called completed contract method, which is something used to be just for small contractors, home builders, right? Under $30 million a year in revenue. Now it's game on. And so if you have contracts that you're going to start or planning to start from now until December, you can consider, what if I start this on January 1, 26, and you'll be eligible. Those new contracts in 26 and forward will be eligible for this treatment. It's a huge tax savings. We're talking to all of our apartment developers who are large and kind of making sure that they know, all right, when can you start? When does it have to start? How do we meet this? Because it is massive deferrals versus picking that profit up over time and paying tax on it over 2 years, or waiting till year 2 or 3 when it's done, and then you pay tax on that income. So it's a big tax savings thing. All right. Last slide. We know this is happening. The green credits were kind of attacked when this bill was being drafted. And so there's really two credits I want to talk about that really impact real estate. 45L is like a green energy credit for the types of building materials you had for dwelling units. This got harder when the Inflation Reduction Act passed in 23. I think it was 23. These got harder to meet, and so a lot of people already kind of pitted down how much they were using 45L, but they're big credits. They were up to $2,000 a dwelling unit. You're a home developer and you build single family residences. This was big for you. You were making, a lot of my clients were getting 50, 100,000 plus dollars in credits a year. Those are expiring. Units sold after June 30, 26. Again, that's next year. Those no longer eligible for 45L if you're looking forward to that. It's still build green. It's great, energy efficient, fine. But then the other one is 179D. These are deductions, very similar, that you need to be using them for green type or energy efficient building products. And these are deductions, and it's based on square footage and the types of materials used. For construction beginning after June 30, 26, these are also phased out. And so, just know that if you use 179D or 45L, you'll know what I'm talking about. You're kind of on a tight timeline to either get the project started for 179D or get those units sold before next year. Last plug before we go to questions. So Mitchell talked about it already. Yeah, we are a boutique firm, CPA firm, right? And so we work very closely with real estate developers, real estate investors, syndicators. We also work with business owners who are investing in real estate, business owners who just own their business, and they have multiple businesses and they have enough entities to kind of make life complex. Those are the people we're trying to work with. We do have space to take on early in filing season if you're still looking for someone, or obviously after May is ideal for us to take on additional K1s or additional tax returns. We are still small enough to where I look at every single tax return and operating agreement that comes into the firm. I want to make sure we're kind of lining out our strategies. We talk about them here. This is how we work with people. We kind of get you in, we assess where you're at right now. What levers are we going to pull? What are we going to do to make it more efficient? How are we going to lower your cost of capital? I'm still deeply and intimately involved with that process. We have managers who you'll work with day in and day out. But yeah, that's kind of our plug for what we're looking for on the firm to listen to. And Mitchell mentioned it. Cost segregation studies are great. You heard it all throughout the presentation. I think they're really powerful tools with the new bonus regime. And use code Big 10, even if you're not in the Big 10.
Yeah, this is because Nick's from Indiana. I think it's a shout out to Nick Heber. But
Another
yeah,
F in
so
the chat.
if we, do we have any we got a couple more questions. So yeah, we're at time right now. We really do appreciate all your time and for you logging on. I mean, this is a great response to listen to us nerd out about real estate tax, but ultimately, we're here and ready to answer. So Rob gives a kind of specific situation of he's lived in a home 2 of the last 5 years. He's depreciated it some, or no, he's talking about depreciating it. It's been a long-term rental. He has a 2% mortgage. The issue, one of the best deals in America is this section 170, 121, I'm sorry, exclusion on the sale of your personal home. Like there aren't many exclusions in the tax code. So a lot of people do this house hacking stuff. You buy a house, you live in it, you go sell it, you get to not pay any tax on your gains up to 250 or 500 if you're married. And so when you go start depreciating your house, you're just going to have recapture on it when you sell it. So like that shouldn't surprise you, but it's going to happen. And so ultimately, if you don't ever want to sell it and you're just willing to give up the exclusion, you just have to decide, do you like the 2.3% or would you rather have the exclusion? And that's up to you. It's
Yeah,
it's a
those are
tricky situation.
those are tough call, but that's a good rate.
Someone said, did carryover credits from prior years expire as well? I think they were talking about the green energy carryover credits. I think those stay live. Like
Yeah, those are
everything that
live.
you did is fine, but you're just not going to be able to generate new credits going forward. Is 100% bonus permanent? Yes, it is. Very much so. It's going to take a act of Congress to remove it. Um,
Leverage up, baby.
uh, Again, is the max real estate pro depreciation to offset of income based on cost seg 662K? Like, yes, W-2 income, interest income, kind of like non-business income cannot be offset more than $600,000 by business losses, whether it's real estate or there's a lot of ways to lose money in business. Um, so
Dimitri, here's a QR code for you to kind of get run through our system. If you're
is
trying to
your
contact us, reach out. Um, there you go.
if you, is your limited partnership if your limited partnership CRE holding company has an S corp that you own outright as a GP, is it kosher to also use that S corp as the management company to collect from the LP? You should set up a new business and collect all the LP money in the asset entity. Trying to like
Again, yeah,
commingle all that stuff
you don't
is
want the
rough.
S corp owning interest in a partnership because you're going to get limited out on debt basis. That has kind of pseudo legal ramifications for can you get fees paid here near the GP? Talk to your lawyer about that. From a tax side, it's probably cleaner just to set up a new management company entity.
Well, and you don't want to go collect all the LP checks inside of your like management company S corp while you're funding a deal. Like go set up a new bank account from the start.
Yep.
You'll
Yep.
thank yourself. Um, so if you 1031 exchange into a new property, can you then run a new cost segregation study on the new house? Yes, you can. Thing about a 1031 exchange is you have to like buy a more expensive property and you have to replace all the property. So like you cannot go sell an apartment building in 1031 into a piece of raw land. You have to replace all the 1245 property. I was talking to a client who's trying to do something like if you go do one of these manufacturing facilities, or if you go say, hey, I'm going to buy a piece of land and put up like a gas station, or these little storage containers that are all you know 5-year property, and I'm going to depreciate the crap out of it. Like by the time you get to the end of that whole thing, you basically have no basis left. And then when you 1031, you just have to do a really, really big deal, or you have to 1031 into something that is that small of a deal with that high of a percentage of 1245 property, which is just really, really hard to do. Um, can you clarify if someone who owns STRs but not full-time real estate pros are allowed to use the accelerated depreciation? Um,
Yeah, this all
so
depends on your level of involvement in the STR, right? And so there's some STR rules on, is it legitimately eligible for use, and we have some material participation rules. So again, if you're not a full-time real estate pro, STRs, a lot of the ways you can work around those rules and still get depreciation, but you still have to meet some criteria to take that deduction.
this is actually the subject of my newsletter for this week, the general ledger. The three ways you can get real estate deductions if you're not a pro at
I love it.
recapturedlove.com. Um,
Going live.
buying a sport fish boat or plane in an LLC, can you deduct the total cost with a cost seg? Also, like if it's an ordinary and necessary business expense, you can deduct it and you don't need a cost seg. You just deduct it. So based on business use, Godspeed.
Doesn't it? Yeah, an attorney who buys an office building become a real estate pro. There's actually tax court cases about this, very similar. So I think I've done one on this. I'll have to dig it up on Twitter. But generally, it's very hard if you have a day job, a W-2, or you own a business as an attorney. It's very hard to then prove that you're also a real estate professional. And by very hard, I just mean impossible. Like it just consistently gets shot down. We see it all the time in tax court. There's like 10 court cases a year that deal with this, and some really good arguments, but it just gets shot down. Like even real estate
but
attorneys or whatever. So unlikely. Marry
but
someone.
like
Recapturedlove.com.
but if you want to go buy a old mansion on Main Street and hang out a sign up front that says, the law office, the Allison Law Office, and you want to occupy that building and use that building as the office of your law firm, you will be able to deduct that building as an office, as a business expense, the same way, a construction company could deduct a forklift. Or that's actually how the Airbnb kind of STR loophole works as well, is that effectively you're not a real estate pro, you're not running real estate, you're running a small hotel that owns its own building asset. So Clark, you're running a small law practice that owns the building that it operates out of, which, depending if you're in Malibu, California, lawyers aren't doing that. If you're, shout out Mike Sylvester, who Fort Wayne, Indiana's best, but he just like when you're in the middle of the country, most professional service firms own their own building, doctors own their own facilities, like most service pros start to do this because at some point they go, look, I'm paying all this rent to this place. I can effectively invest this cash. It's like an IRA or like a 401k in that I can go take 300 grand, borrow some money, buy $1 million office building, deduct the 300 grand year one, and be on the road and paying myself. Logan posted the qualifying as a real estate pro article.
Yeah, Cossack has some good articles on that. Newsletter. There's a sign up.
Um, go to arikosig.com and use the calculator. And we do small houses all the time. We do, I say 100K crummy little rent houses all the way up to $100 million, office buildings. We have the rapid product for really, really small stuff. So, um, if you can't use the depreciation up front, it's just a passive loss. So like with partners who aren't real estate pros who get stuck into real estate deals and can't really utilize the losses, the good news is that at the end, when everyone's scrambling about how am I going to 1031 or I'm about to get totally crushed by recapture, like those people are all sitting pretty. Like they just don't care because they never created this deferred tax liability. They never like got beat up by this whole mechanism, so they're not like chasing the depreciation dragon. They're just sitting there with this big old negative capital account that's, but it's all offset, like it's all suspended. So when the property goes and sells, or when a different property goes and sells, or whatever happens, they just have the losses kind of sitting there ready to be utilized. So like, you know, big family offices or the wealthy generally have more passive income than they know what to do with. Like I deal with all these, so a lot of people are trying to use the passive losses over here, and then some people are like, yeah, give me passive losses. I need them because I've been in these deals for so long and have eroded my basis so greatly that I just have passive income every year that I want to offset, you know.
Humble brag. Yep.
Humble brag, yeah. Well, it must be nice, right? Um, for single family rental properties, what is the typical amount? It's 25 to 35%. Again, go to try that like bonuslevers.com calculator, bonus levers, which there's a little baseline and there's an optimistic, but when you go look at residential, you're talking about, we're saying 27 on the baseline and 38 on the optimistic. So again,
Yeah.
is it on a cliff in Malibu or is it in Topeka, Kansas? Is there a big sport court in the back with a pickleball station and a hot tub and a jacuzzi and a water slide, or is it just a bare bones house? So
Linda has a good question on reps. There's a lot of articles out there. I think Ari Kostek has some blogs on it, but it's over 750 hours a year spent on real estate activities, and more than one half of your total time is spent on real estate activities. And there's very specific rules on what real estate activities are. Every case is different. You need to take a look at that. There's a lot of good stuff out there. So just there's some rules.
publication 925, passive activity
Boom,
and at risk rules. Just
boom.
go get it, Linda. Well, shoot, I think we've done it. So we
Mission
again really
accomplished. I got the
appreciate your
banner.
time.
Let me unroll the
Yeah,
banner.
yeah, we did it, y'all. This could be considered nothing but a success. So thank you for your time. We appreciate you. We'll follow up later this week with a recording of this. Email us if you have any questions. And this was awesome. Thank you all.
Thanks, guys.
Take care.